welcome back. Hope you all had a fantastic Easter break. But just getting into the thick of it, quite a few headlines to get you up to speed with. And how the market's looking this morning in terms of, don't forget, the US were in as per normal yesterday, but UK and Europe were closed for the extended kind of weekend. So I think first off, having a look at the DAX in the centre left, we had a fairly decent gap up in the futures this morning. However, we have just drifted south since that point. But understanding the reason for that move, I guess we just have to have a look at the S&P from yesterday. And really just looking at, firstly, two things. Looking back on, if I make this slightly longer dated chart, looking at the S&P from the end of last week. So on Thursday, going into the Easter break on Friday, we broke quite a key level late in the session. So this was after Europe had gone home and closed, and into the kind of the very last part of the US session. And we broke a pretty key technical level that prompted quite aggressive selling pressure. That was around that 32.25 level in the S&P. That was that previous level tested a few days prior when we had that big sell-off on the Tuesday, I think it was, a week ago. And then also it defined some of the price action around late March. And so we broke that. What you tend to often see going into an extended holiday is obviously liquidity dries up a lot. A lot of people just closing out positions, not wanting to hold anything over a market holiday period. And so we just probably exacerbated some of the move to the downside. Now, the more interesting thing that happened though was yesterday when we were out of the market, so UK, European indices were closed, is we saw pretty quiet throughout the whole morning in US futures. And then as soon as US came into market, they started to bid up the market all the way up, full reversal of that sell-off from Friday, back up towards actually, or Thursday I should say, those highs where we sit at the moment at 42.75. So very strong buying seen in the S&P yesterday in a much lighter volume than is normal given the fact that Western Europe out of the market. So that explains a bit of the catch-up move then in the DAX this morning, hence the reason why we've gapped up. It's just playing catch-up more than anything else from that move. But ultimately the S&P is broadly flat to slight negative in the futures this morning. Reason for some of this movement that we had in the US, just catching up on some of the headlines that we had over the weekend, where obviously going in there was a lot of jitters about North Korea. They had quite a big, I think it's called the Sun sort of celebration that they have over the weekend, and essentially everyone was getting a bit panicky about the escalation of the fact that they were threatening with potential, or history would tell us that when they have these annual anniversaries, they tend to show a kind of military might, doing tests in terms of missile launches and so on and so forth. Now they did do one at the weekend. The only problem was that their missile test failed, according to the US and South Korean officials. So an attempted missile launch by South Korea on Sunday failed. The attempted launch occurred a day after the regime showed off a bevy of new missiles and launches at a large-scale military parade of one of its most important market holidays. So they did, as expected, follow suit, just kind of show the world the power that they have militarily, but then a failed missile launch probably dispelled any fears about imminent type strike action in that part of the world. And so if anything, there's been a bit of de-escalation on the Korean peninsula since. You've also had a couple of comments out of the US main official, Mike Pence, urging Beijing to rein in Pyongyang's nuclear missile program. So pretty much a reiteration really of the US's stance at the moment. The vice president warned North Korea not to test Trump's resolve, saying that Washington wanted the communist state to abandon nuclear weapons and end its unacceptable missile tests. Now, that's fine, the US saying that, but actually the bigger play and development that we had at the end of last week is that Trump did that kind of big U-turn about terming China a currency manipulator. So it's kind of I'll scratch your back, you scratch mine. I'll stop calling you a currency manipulator. You just sort out the Koreans in the north, and then everything's back to normal. So that's kind of the bigger play that seems to a little bit of the fear of that situation on the geopolitics seems to have gone away, as some of the kind of focus on this Syrian situation. Nothing really a great deal out of the Russians, Iran, Syria over the weekend either. And so here we are in terms of market pricing this morning. Gold seen a little lower, down around $5.50 this morning. But obviously gold's been an interesting one, because we've had if we put it on a weekly chart, we've had such a strong rise over, these are candles of weeks. So we had, what, 1, 2, 3, 4, 5 consecutive up weeks, taking us all the way back up to a close test of 1300. If we look at where we opened electronic trade last night, we got up to 1297.5, so just within a whisker of that 1300 kind of psychological level. So definitely we'll be keeping an eye on that this week. And certainly, as you all know, we got the French elections coming up on Sunday. So this is the final week, and one would imagine that uncertainty surrounding that situation will only increase as the media attention kind of intensifies going into that first round vote. So certainly that 1300 to watch in gold prices, which have been a fairly good lead indicator last week of risk sentiment. That and both the Japanese yen, given the fact that the market's a little bit disinterested in economic data at this point, given how far away is the next central bank meeting of significance really globally. Everyone's looking as towards risk sentiment to kind of gauge things at the moment. So here comes the DAX now, just closing the gap. So we've just slipped below pivot here in the DAX, back down towards where we closed on Thursday. Now this to me does make fundamentally complete sense when we start to look at some of the other news. Now, although tensions on the Korean Peninsula have lessened, obviously we just briefly mentioned, we'll have a closer look now, is that the French election has now come upon us, and this is only going to add, I would say, increased nervousness in the market, higher degree of potential volatility, and I would say what you typically tend to see in these big political events like EU referendum and Trump in the US election is that a lot of the polling and so on and so forth starts to converge, and that kind of exacerbates the whole uncertainty on the situation. What you've had then is, well, Emmanuel Macron, he delivered a speech yesterday, had a campaign rally on Monday, trying to drum up final part of support. Quite interesting though that political heads have said that everyone in terms of the top 4 candidates is petrified. Basically they're just trying to not lose votes at this point, rather than trying to come out with some kind of deal breaker to make people back them. Almost a third of the electorate, according to Kantar, which is one of the main pollsters, almost a third of the electorate is still undecided, and the front runners clustered around at 20% in the polls in the first round, obviously this Sunday, so making one of the most unpredictable the country has seen in recent history. Looking at the actual polls then, let's have a look. Really these are the 5 main candidates, but really I think you can pretty much discount Benoit Hamon. He is kind of out of the running, he's so low down in the polls. So really it's a cluster of the familiar names now. Macron, Le Pen, so this is, I would imagine this is the poll of polls. They are neck and neck. Fillon and Mélenchon are also pretty much neck and neck. The prospect though that's has made the market a little bit nervous more recently is the fact that Fillon has recovered slightly from late March, when he was under the most pressure on those allegations that came his way from the likes of authorities looking into misspent tax money. And then Mélenchon has had a phenomenal rise really since mid-March, going from really a no-hoper around 11% all the way up to 19%, and there's a real possibility of making it through to the runoff. The runoff though, in terms of what's the main scenarios is either Le Pen Macron or Le Pen Fillon, as you know, and the bigger divergence between what the polls are suggesting is that if it was a Macron-Le Pen situation, then all the more higher probability then that Macron would win rather than Fillon. Looking at this is the FT kind of poll updates that they're doing, and it has all the underlying polls. So if you ever wanted to go through and do some research about every single poll that comes out, it's a fairly decent website to bookmark if you like. Looking at the Le Pen Macron situation, obviously this was let me just bring up this one. This is what we were looking at last week, and it was looking at the potential kind of scenarios based around who would be most likely, according to polls, to be triumphant, given various different scenarios. The FT only really looking at 2, but obviously there's a lot more mixture that you can have. Actually, the most destabilizing for market price would probably be Mélenchon and Le Pen. Now, as you all well know, is that both of these candidates are, well, one's a Eurosceptic and the other wants to exit the EU altogether. So either way, it's to the detriment of the Euro kind of sentiment and ideology if these two were to get through the first round. I would say from a trading point of view, I know we briefly touched upon this last week as well, is that actually I think the first round vote is going to be much more market moving potentially than the second round runoff. That's because depending on who gets through, the market will then have to reprice. Now that will either be Macron, Le Pen into the runoff, which means that actually I think you might get a mild relief rally in European assets, i.e. Mild appreciation of the euro currency and European equities, and a little bit of a pull down in French yields, which have been elevated given the risk associated with the event. But if you were to get Mélenchon qualify for the runoff and not Fillon and not Macron, so it's Mélenchon, Le Pen, then you've got a real problem on your hands, and I think you'll see quite a negative knee-jerk response in the markets when they reopen on Monday. Things to definitely keep an eye on this week, and will probably draw a lot of press attention, is looking at France. You've got monitoring of French yields, so that's debt costs, the cost of France's government debt. The yield it pays on its bonds known as OATs, which is their benchmark. So when we talk about bunds, the French equivalent is the OAT. And what you're starting to see is as French yields start to rise, associated with the uncertainty on this event, is that it's pulling away from the benchmark German bond yield, and therefore the spread by default is widening, reflecting widening a spread, more risk, a tightening less, but it's moving wider and further apart at this present point in time. As you can see here, some of the movement in the yields going into 2017, late 2016 have been elevated, particularly Italy. Obviously it went through that period of a banking crisis, so to speak, towards the second half of last year, which means that their yield's still sharply higher than others. The other thing is French bank stocks though, and actually quite an interesting graphic with those is that although they've seen a slight dip more recently in the bigger names, BNP, SocGen, Credit Ag, and the CAC Courant is actually trading around its highest for more than a year. Now, although we have seen a general appreciation of global equities anyhow, quite a lot of commentary is suggestive that the election has not had an economic impact. It does not look as though companies are holding back on their investment decisions. So maybe in the corporate space they're a little bit more optimistic on the fact that we're not going to see a Le Pen win. Euro yen, that's been an interesting one, given the fact that I did see a stat over the weekend. Euro yen has fallen for 5 weeks in a row. A sequence of weekly losses extended to 6 weeks, only 4 times since the history of the euro inception. So obviously going back to the late 90s. So euro yen remains under pressure, and this is a dual force really on the question of risk. And so not only have you got the French election, but obviously this heightened tension in geopolitics meant that the yen was strengthening in that flight to quality move, certainly that was prevalent last week with gold and the Japanese yen. But then also you've got the weakness that it might imply that if you were to get a Le Pen win in that initial depreciation that you would likely see in the euro currency. So euro yen's been a very interesting one to watch. So that's kind of your French roundup, so to speak. And so that's kind of part one, I would say, of the reason why I think you can understand the weakness in the DAX that you've seen here after that initial gap lower. So catch up, gap up on the US move and US equities moving higher yesterday, the de-escalation in North Korea. However, the French election is looming. Then also there was this comment as well from the Treasury Secretary of the US, which is important and actually I think carries quite a lot of weight, although it's not grabbing a whole lot of attention on the headlines. But this is what the market has really feared. And this is that idea about the Trump trade that's been in such force since November of last year, and that market participants might well soon become fatigued by the idea of what actually can Trump deliver. And actually there was a really important article in the FT at the weekend by Treasury Secretary Mnuchin, who rejects currency war fears, plans new serious sanctions, but most importantly admits that Trump tax reforms will be hit by the healthcare setback. So he said that it conceded the administration's timetable for ambitious tax reforms is set to slip following setbacks in negotiations with Congress over healthcare. Now this is like the first sign of a little bit of a nod towards moving and prepping the market. It's almost in a central bank-esque style, communicating to the market that, you know, we might start to move the goalposts going forward, and actually we might not hit this target, this quite aggressive one that we initially had put out there. And so the market obviously has been pumped up to a large degree on this forthcoming fiscal stimulus from the Trump administration. But this comment would say that actually we need to start readjusting our expectations around this particular matter. Now, if the market starts to lose faith on that, and let's say if you get a Le Pen Mélenchon situation, this could become quite a negative market setup, and certainly that 1300 would be taken out in gold on the upside, and would be expecting possibly some short-term at least weakness in equity markets and fixed income to be supported by those events. Just moving away from these comments though, and quick look at some other headlines. You did have at the weekend some economic data coming out of China. Now, this is actually one area of the global economy that actually seems to be performing relatively well, is that Chinese GDP has picked up again. The Chinese economy expanded 6.9% year on year in the March quarter 2017. That was above expectations of 6.8. But if you remember, back at the beginning of 2016, people went into panic mode after we had a decline from the summer of 2015 from 7, 6.9, 6.8, 6.7%. People were starting to question whether or not we'd be in for a hard landing in terms of China. But then what happened was we stabilized, and now we've picked up back to the highest growth rates really since the summer of 2015. And so any concerns about China certainly have dissipated, and that is a net positive on that one specific geographic region. You also had out some other data from China. Industrial production at the weekend, stronger than expected. Retail sales, stronger than expected. Fixed asset investment, stronger than expected. The one actual grey spot though of the Chinese economy continues to be iron ore, which dropped to its lowest level in 5 months. Now, we've been talking about iron ore quite a bit actually in recent briefings. This is to do with an overall oversupplied market at this present point, and also the type of iron ore that's in supply is the wrong type of grade essentially. And so iron ore has had to reprice on the Dalian commodity exchange, and as such keep an eye on the Aussie currency if this continues to draw some further attention. That doesn't mean that just because of this headline, Aussie's going to sell off today all of a sudden. This is a bigger macro theme to be aware of for trading the Aussie over the short to medium term, given its strong link in towards these types of industrial metals. One of the other things in commodities, just to be aware of any oil traders, because I know there are a few of you out there that follow the product very closely. I just saw this headline, I thought I'd point it out. This is Citigroup have joined Goldman Sachs in backing commodities, saying it's the season to have faith in raw materials, and oil will probably rally to mid-60s by the end of the year. So basically Citi, like Goldman's, of the opinion that mid-$60 oil seen by the end of this year's OPEC cuts offset US shale. So obviously US output has continued to increase, but they're saying that OPEC will continue to stand in the way of any particular price decline. And where we are at the moment, we've obviously been on a fairly roller coaster period over the course of really the last 6 weeks, where you had a lot of focus on that US output situation, but lo and behold, OPEC to the rescue, up the ante on the talk about potential intervention and further extension of cuts. Russia gets involved, and then we use break of 50 as a springboard just to go higher again amid some of that commentary. So where Citi are looking, and Goldman's by year end, is to move back up in towards 60, which would put us back to that cluster of price action where we were trading kind of early summer of 2015 as a natural price point. So if we break that 55.24, which was the high that we're seeing really towards the beginning of the year, I think it was the third day of the year we touched that 55.24, then be looking down to the low of that cluster of price action at 56.51, but then it starts to open up a bit of air towards that target that some of those banks are looking for. Okay, so quick look at the calendar for today, and a few things to be aware of is that there's not really a great deal coming out of the UK or Europe this morning. Let me just transition my screen so you can see it. But from the US afternoon, we do have a couple of housing related numbers, permits and starts for the month of March. I wouldn't assign too much impact value to either of those releases. You do have later industrial production coming out of the US, cap utilization alongside that as per usual. Don't forget, all inventory data from the API will be released today as per usual, because it was not a US market holiday yesterday despite us being away. So you'll get that later on tonight with the DOEs to follow on Wednesday. Speakers, you do have Fed's George speaking at 2 and Rosengren at 5, neither of which are FOMC voters though. And so overall, a fairly quiet schedule. Nothing on the data side really makes me think that there's a great degree of risk of catalysts here to cause market movement. Actually, I'd say probably the bigger thing to be monitoring is just general risk appetite. So following likes of gold and the yen, and then equity movement at the Wall Street Open will be interesting, given the dual forces of almost a capitulation of anxiety over the French election, in combination with the Treasury Secretary comments talking about potential delays to the tax reforms and fiscal reforms in the US. I would say would put the market fundamentally on a negative bias in that respect. Looking at the week as a whole, don't forget you've got US earnings. You had the banks last week. They're just the beginning. And this week it starts to ramp up quite a bit. There's 46 S&P companies reporting this week. Some of the big names today, and what we will see pre-market, is Goldman's and Bank of America. Now, just because Goldman's is a bellwether bank name, don't think that just by that reason alone is going to move the market. Essentially, the banks last week generally were fairly healthy and exceeded expectations, and so Goldman's and Bank of America are expected to do the same. Now that the first names of that sector have already reported, then it's highly unlikely that it's really going to going to shift the balance of market sentiment for the banks reporting. You also have Yahoo, J&J, IBM as well today. This week, eBay, Morgan Stanley, Verizon, just to name a few. So earnings do pick up pace. So I'd probably keep half an ear on those. But I'd say, given the broader macro themes ongoing, I don't think earnings season overall is going to be too much of a concern for financial markets for this quarter. Looking at the actual schedule for the week, so Wednesday you get Eurozone inflation, which could be interesting, but otherwise a fairly quiet day. Thursday, likewise, fairly quiet again, but you've got Bank of England's Mark Carney, the governor, speaking. Friday is actually the most interesting because that's when you get some of the PMI numbers coming out. You've also got UK retail sales, which will obviously be a key metric to keep an eye on going forward, given the fact that it's generally been weakening on the back of heightened inflation and the ability of the consumer to spend. And then you've got existing home sales and the US PMIs to follow as well. So not too busy on the calendar. Friday's probably the most economic data sensitive, if you like. Then you've got earnings sprinkled across the week. Remember, corporate earnings tend to be kind of bell-shaped distribution, i.e. very few on Monday, very few on Friday. It tends to be really midweek that you get the bulk of those earnings reports. But that's pretty much it in terms of the briefing for this morning. So coming up to 9 o'clock, I would say just taking a look at the charts then this morning since we've been delivering the briefing. Obviously the DAX seen a bit of pressure here. Oil as well, just touching on a low. Cable though has outperformed. And if we look at cable, we've just managed to get above the high that was seen yesterday when electronic futures trade. We've just had a brief flirt above R1 before pulling back to around that high from yesterday. Now, Euro dollar is not really moving and the dollar index is pretty flat, but if you think about those two other currencies, you've got two negatives obviously in play where the pound doesn't really have that. Although Brexit is ongoing, Brexit is by no means anything that's really near-term risk for the pound, because as we know, Brexit talk is not really going to get underway until the end of May. Bigger concern for the market from a macro perspective for this week and short term is the French election, and then also as well this idea of further delays on the Trump administration and their fiscal reforms means that both those euro and dollar negatives, sterling's probably just outperforming on the back of that. So cable, I think in the spot, first time above 126 in 3 weeks. Okay guys, 9 o'clock, so I'll let you crack on. Wish you a good week ahead, and I'll catch you in the chat room. Thank you.